Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference, and I'm here with Mark Kiesel, Chief Investment Officer of PIMCO. Mark, great seeing you.
Great to see you, Tom.
I know it's an exciting conference, and a lot of advisors are really wondering what to do on the fixed income side. There are a lot of potential headwinds down the road, and you meet with thousands of advisors every year. What are you telling advisors today?
Well, actually, there's a lot of opportunity right now, Tom, and for the first time in about 6 years, the yield on long credit is actually higher than the free cash flow yield on equities. So for the first time in basically 6 years, bonds are starting to really look cheap again, particularly credit markets, and also relative to equities. So for people worried about rates going up, we think the pace of rate hikes is going to be very gradual and slow, and that bonds, because of the much higher yields now, particularly in the credit markets, are going to support investors.
It doesn't mean that all bonds are created equal when rates go up, right? There are periods of times when actually credit markets have done quite well.
Yes, and that's a great point, because if you look since 1972, there have been 6 or 7 rate hike cycles. 6 months after the Fed raised rates, in all those times, credit spreads tightened. So the reality is, to your point, not all bonds are treated the same.
Yeah.
Yes, longer duration treasury bonds we think will underperform, but we actually think corporate bonds, specifically credit bonds, will outperform going forward. We also are very positive on the TIPS market.
Okay, so a lot of money's gone into fixed income ETFs over the past 5 years, and maybe buying the Barclays Ag may not be the best strategy going forward?
We don't think so. We think there's never been a better time than now to be an active manager. What Bond does is specifically try to look at global fixed income markets and get investors in the right risks at the right time. We're taking less interest rate risk today because we do think rates are going to be rising gradually. At the same time, we're actually taking specific risk in Treasury inflation protected securities. The break-even inflation rate on TIPS today is 1.3 to 1.4%. That means for the next 5 to 10 years, investors are only expecting 1.3 to 1.4% inflation. If inflation's higher than that, TIPS should outperform. We are actually owning a lot of TIPS right now. We think inflation protection is underpriced.
And you mentioned bond, that's BOND, or actively managed ETF on the fixed income
Correct.
side. And for the average investor who's thinking about, oh, do I have treasuries? Do I not have treasuries? Do I shorten duration? Do I go for more yield? That's really what you provide,
Exactly.
all that guidance within BOND.
Exactly, and what we can deliver in BOND is a portfolio that actually yields more than the index with less risk, specifically less interest rate risk. What we are doing today in the context of the Fed set to raise rates is taking less interest rate risk. We're taking more risk in international markets, more risk in countries like Mexico, where the fundamentals are actually set to improve. We are long the dollar right now. We think with the US economy doing well, the dollar will appreciate. And in addition to TIPS, we also are favoring the credit market, specifically housing-related investments, non-agency mortgages, building materials companies, home improvement companies. The U.S. housing market is growing 2 times faster than the overall economy. That's how you make money today.
Absolutely. Well, so the guidance is you don't have to jettison everything that you have on the fixed income side, but you should start to be diversifying into active management because there really are some headwinds coming.
We think the headwinds are really rising interest rates, albeit gradually, and inflation is set to pick up off of a very low base. So basically what caused the decline in the inflation rate was primarily commodity energy prices. Going forward, inflation we think will trend up towards 2%. By owning TIPS, you're locking in inflation protection at a very low cost. Again, break-even's 1.3 to 1.4. That's the way we think to outperform going forward.
So picking the spots is going to be the way to go.
Absolutely.
Great. Mark, as always, great seeing you.
Great to see you.
Thank you.
Thank you.